The Bank of Canada just made another interest rate announcement, and if you're a homeowner, homebuyer, or have a mortgage renewal coming up, this decision could impact you. Many Canadians were hoping rates would finally start moving lower. Others were worried that inflation would force the Bank of Canada to raise rates again. Instead, the bank chose to hold its key interest rate steady at 2.25%. Here's what caught my attention. The Bank of Canada is now trying to navigate multiple global events at the same time, including rising oil prices, inflation pressures, economic weakness, ongoing trade tensions with the United States, and uncertainty surrounding conflicts overseas. So today, I want to explain why the Bank of Canada decided not to move rates, what Governor Tiff Macklem is watching right now, and what this could mean for mortgages, home prices, and the Canadian economy over the coming months. Let's get into it. The Bank of Canada is stuck between two problems. The reality is that the Bank of Canada is facing a difficult balancing act. Normally, when the economy slows down, central banks lower interest rates to encourage borrowing and spending. Lower rates can help businesses invest, help consumers spend more money, and generally provide support to the economy. The problem right now is that inflation is still hanging around. Canada's inflation rate recently climbed to 2.8%, and the Bank of Canada expects inflation could remain close to 3% before eventually moving back towards its 2% target. That's important because inflation is still higher than where the bank wants to be. If they cut rates too quickly, inflation could move even higher. If they raise rates to fight inflation, they risk slowing an already weak economy. So they're caught in the middle, and that's ultimately why they chose to do nothing this month. Rising oil prices are creating new concerns. One of the biggest developments recently has been the rise in oil prices. Tensions and conflict in the Middle East have pushed energy prices higher, which affects everything from transportation costs to heating and fuel expenses. When oil prices rise, inflation often follows. The Bank of Canada acknowledged this concern directly. Right now, they don't believe higher energy prices have significantly spread throughout the broader economy. In other words, while Canadians may be paying more at the pump, those higher costs haven't yet shown up everywhere else. But Governor Tiff Macklem made it clear that if oil prices remain elevated for an extended period of time, those costs could eventually filter through the economy and create broader inflation pressures. If that happens, the bank may need to respond, and that's one reason they're not rushing into rate cuts. The economy is weak, but not weak enough. Another reason rates stayed unchanged is because Canada's economy is sending mixed signals. On one hand, the labor market recently showed some positive news. Canada added approximately 88,000 jobs in May, and the unemployment rate actually fell to its lowest level in 5 months. At first, that sounds encouraging. However, when you zoom out and look at the bigger picture, job growth has been relatively flat throughout most of the year. Governor Macklem noted that while monthly employment reports have been bouncing around, there has been very little overall progress in job creation since January. In other words, the economy isn't collapsing, but it isn't exactly thriving either. And that's making it difficult for policymakers to determine what comes next. Is Canada in a recession? One question many Canadians are asking right now is whether we're already in a recession. The answer depends on who you ask. Canada's economy actually contracted slightly during the first quarter of the year. Statistics Canada reported that real GDP declined by 0.1%, coming after a previous decline in late 2025. Many economists have started debating whether Canada is entering recession territory. However, Governor Macklem doesn't believe we're there yet. His view is that while economic growth has been extremely weak, it hasn't experienced the kind of broad-based decline typically associated with a recession. His message was essentially this: the economy has been moving sideways. It's not growing much, but it's not shrinking enough to clearly qualify it as a recession either. For homeowners and borrowers, that distinction matters because recessions often lead to aggressive rate cuts. If the Bank of Canada doesn't believe we're in a recession, they have less pressure to lower rates quickly. The trade war risk nobody is talking about. Another factor weighing on the bank's decision is ongoing trade uncertainty with the United States. Potential new tariffs continue to create uncertainty for Canadian businesses. Tariffs can have a unique effect on the economy because they often create inflation while also slowing growth. That's exactly the type of environment central banks hate dealing with. Higher costs push inflation up. Slower economic activity pushes growth down. And suddenly, the Bank of Canada has fewer tools available. Until policymakers get more clarity on the trade situation, it's likely the bank will continue taking a cautious approach. What does this mean for mortgage rates? This is the question I get most often from my clients. If you have a variable rate mortgage, June 10th announcement means your payment remains unchanged for now. Prime lending rates stay where they are, which means variable rate borrowers won't see an immediate relief. For fixed rate mortgages, things are a little different. Fixed rates are driven more by bond yields and investor expectations than by the Bank of Canada's overnight rate. If investors begin believing the economy is weakening significantly, fixed rates could drift lower even if the Bank of Canada doesn't cut rates immediately. However, if inflation remains stubbornly high or oil prices continue climbing, fixed rates could remain elevated longer than many borrowers hope. That's why it's important to focus on your individual mortgage strategy rather than trying to predict every move the Bank of Canada will make. What I will be watching next are three things. First, inflation. If inflation starts moving meaningfully above 3%, the Bank of Canada may need to keep rates higher longer. Second, employment. If job losses begin accelerating and unemployment rises, pressure will build for future rate cuts. Third, energy prices. If oil prices remain elevated and those higher costs spread throughout the economy, inflation could become a bigger concern than many people expect. Those three factors will likely determine where rates go next. Here are my final thoughts. The biggest takeaway from this announcement is simple. The Bank of Canada isn't convinced inflation is fully under control, but it also recognizes that the economy is struggling. Rather than choosing one side of that equation, they've decided to wait and gather more information. For now, that means rates remain unchanged at 2.25%. What does this mean to the consumer? If you are in a product that depends on the prime rate of 4.45% today, that remains unchanged. Whether you're renewing your mortgage, purchasing your first home, or simply trying to understand where the market is headed, it's important to remember that uncertainty remains the dominant theme right now. And while many Canadians are focused on whether rates will go up or down next, the real story is that the Bank of Canada is still trying to determine which risk is greater: higher inflation or a weaker economy. As more data becomes available over the coming months, we'll get a clearer picture of where things are heading. If you have questions about your mortgage, renewal options, refinancing opportunities, or how these rate decisions could impact your situations, feel free to reach out. This is Rasha Ingrata, Mortgage Agent Level 2 with Mortgage Intelligence, proudly serving Windsor, Essex community since 1999. Thank you and have a wonderful day.